Hello, we're presenting week 8 valuation. These are our team members and their student numbers. This is the outline of our presentation, which will analyze the net present value of our selected companies and how our stock's intrinsic value compares to current market prices. Due to the sensitivity of the net present value on our free cash flow projections and the weighted average cost of capital estimates, we're also going to provide a description of the method used to obtain these numbers. Our chosen companies are GSK, Johnson & Johnson, AbbVie, Eli Lilly, AstraZeneca, Vertex, and Hikma. We chose pharmaceuticals since it is in the same industry as GSK, and this makes the comparison more meaningful. We choose a wide range of companies varying in the market cap, specialization, companies from both US and the UK to observe how performances differ.
For revenues, we used the average year-over-year growth over the last 20 years. We did this to smoothen out volatility that firms experience over time and make predictions consistent with the past performance. For example, GSK revenue projections can be seen on the graph on the left. In some cases, qualitative adjustments have been made. For example, Hikma experienced exponential growth during its early stages, which is unlikely to be sustained. The adjusted projections can be seen on the graph on the right. For costs and other items, we decided to forecast their margins of revenue to identify long-term trends and changes in efficiency. Normalizing each variable allowed to better compare the performance of firms. Our forecasting method consisted of two steps. We performed a linear regression of the margins and then multiplied the results by the forecasted revenues to get the absolute values. Some of our forecasts can be seen in the graphs below. The graph on the left shows the forecast for the margins, while that on the right shows the absolute values.
Again, we had to reconcile our projections with recent trends by making qualitative adjustments. For example, our model forecast that shows a sudden jump for Eli Lilly and SG&A margin, which is unlikely to happen as it is evident by the clear downward trend. The results of the adjustment can be seen in the graphs below. Also, to calculate the free cash flows, we use the formula depicted on this slide. The resulting free cash flows forecasted for two of our companies can be seen on this graph. An example of the free cash flow calculation for Eli Lilly is shown in the table provided in the top of this slide. We decided to calculate our own betas using the S&P 500 as the market index. This is because of the heavy exposure of all of our companies, including the UK ones, to the US market, which can be seen in the revenue segmentation graph.
For the market risk premium, we decided to use the 10-year S&P 500 data and the 10-year US Treasury note yield. We did not take a shorter horizon to avoid capturing short-term volatility due to the recent effects of quantitative easing. We also did not choose a longer horizon to reflect the current market dynamics. The weighted average cost of capital was then calculated using the formula provided. For cost of equity, we used the capital asset pricing model. For cost of debt, we divided the interest expense of the company by their outstanding debt. To understand the NPV obtained through our analysis, it is important to differentiate between traditional NPV for projects and the formula used for valuing firms. In valuing firms, there is no single upfront investment. Instead, the investment is continuous and captured in the free cash flow projections through capex and changes in net working capital. The firm's NPV is therefore the sum of the present value of free cash flow projections and a terminal value. As forecasting free cash flows indefinitely will not be reliable, terminal value is used to value all the free cash flows into perpetuity by assuming a constant terminal growth rate. The formula is depicted on the slide, and the NPV is reported in the table. The company with the highest net present value is AbbVie, followed by Eli Lilly and Johnson & Johnson, while companies with the lowest NPV are Hikma Pharmaceuticals, Vertex, and GSK.
In order to calculate the intrinsic value of the shares, we deduct the value of the net debt from the enterprise value to get implied market capitalization, which is also called the equity value of the company. This calculation can be seen in the table on the left. All companies had positive net debt, except for Vertex, which had more cash than outstanding debt. The equity value is then divided by the number of outstanding shares to obtain the implied share price. Our results are summarized in the graph where the intrinsic value is compared to the market price of the stock. We choose a logarithmic scale to ensure better visibility due to a wide range in share prices. This graph depicts the percentage by which the intrinsic value is above or below the current market price. The percentage reported represents by how much the market price would have to fall or increase to equal the intrinsic value of the share. Before we proceed with the intrinsic value analysis, we feel it is necessary to differentiate between the intrinsic value and the market price. The intrinsic value of a stock represents its true underlying worth based on factors such as earnings, growth potential, and risk, while the market price is determined by current market demand and supply. The difference between the two can arise from various factors, including economic conditions, investors' emotions, news, or speculative behavior. These factors can cause the market price to deviate from the stock's intrinsic value, especially in the short term. Based on this, we have formulated some hypotheses for each of our companies to explain why their stock may be over or undervalued. GSK's undervaluation may be the result of more pessimistic opinion of other investors regarding the future prospects of the company. Furthermore, the recent Zantac lawsuit might have increased pessimism. The weak past performance of the stock could have also discouraged investors from buying, causing the price to be suppressed. AbbVie was the only company we could consider to be fairly valued. The small overvaluation may be the result of market price fluctuations and approximation. This means that the market shares similar views to ours. For Vertex, the overvaluation may have been caused by higher optimism on cystic fibrosis treatment, which accounts for the majority of the company's revenues. Furthermore, the high past returns may have incentivized speculative behavior amongst investors. ICMA stocks may be undervalued due to more pessimistic forecasts and due to the underperformance experienced in recent years, which may have reduced demand for the stock among investors, further suppressing the price. AstraZeneca stock may be overvalued because of two main reasons. First, investors may have optimistic views on future growth due to past performance during the COVID-19 pandemic, as the company was one of the main vaccine manufacturers. Secondly, the cost margin has seen an upward trend over time. Although some analysts believe this trend to reverse, we do not share their view. Eli Lilly has the most overvalued stock among our companies. This could be due to growing optimism regarding obesity treatment and the recent $27 billion US expansion plans. Moreover, the high past return of the stock may have caused investors to engage in speculative behavior, further increasing the overvaluation. On the other hand, Johnson & Johnson stock will be overvalued due to more optimistic growth forecasts and shorter market price fluctuations.
We have three main limitations to our analysis. Firstly, our analysis is highly sensitive to betas, weighted average cost of capitals, and terminal growth value. While we adopted utmost care in determining these values, other investors may disagree. Therefore, the relevance of our analysis is affected by the accuracy of these estimates. Secondly, although our projections seem theoretically reasonable, they're heavily dependent on the assumption that the trends in item margins will not change in the future. Therefore, if this assumption were not to hold in practice, our intrinsic value could be inaccurate. Third, we adopted a conservative approach regarding growth rates, and therefore, this analysis may be considered by some as a worst case scenario. Therefore, adopting a more optimistic approach to growth rates may change the findings of this analysis. Lastly, given our limited industry expertise, we opted for a quantitative approach by focusing on historical trends and assigning limited weight to planned projects or expansions. Therefore, adopting a more qualitative approach may lead to different results. Well, these are our references for our research. You can also find the links to our Excel sheet, Python script, and slides in the video description. We hope you enjoyed, and thank you very much.